In Chapter 5, we will be discussing the audit evidence and documentation. So if you look at our flowchart on page 129, in Chapters 3, we talked about client acceptance and continuance. We looked at preliminary engagement activities, and now we're on the last chapter of planning the audit. Specifically, here's what we'll be learning in this chapter. Understanding the relationship between audit evidence and the auditor's report. Know management's assertions about classes of transactions, account balances, presentations, and disclosures. So what's management asserting? Learn the basic concepts of audit evidence. Know audit procedures used for obtaining audit evidence. Understand the reliability of the type of evidence. Understand the audit testing hierarchy. Understand the functions of audit documentation. Develop an understanding of the content, types, organization, and ownership of audit documents. We'll be looking at analytical procedures, and we'll look at financial ratios that are used in analytical procedures. So let's get started. First of all, audit evidence is what is used to determine the opinion of an audit. So an auditor has to understand the nature and character of evidence and its importance. And it is a key component of our toolkit as an auditor. Most of our work, we are obtaining and evaluating evidence as auditors. Now on page 130 of your book, there's an overview of the relationship among financial statements, this management assertions, audit procedures, and then ultimately the audit report. So we're always given financial statements as auditors. Within those financial statements, management makes assertions, and we're going to talk about those in a few minutes. What are they asserting to? Based on those assertions, we create audit procedures. We collect evidence and reach a conclusion based on this evidence that helps us develop the audit report. So that is our process. Right now, we are still looking at collecting the financial statements and seeing what management's assertions are. Again, one more time, audit evidence is used to support our opinion. So back in Chapter 3, we talked about the type of procedures used to gather evidence. What does an auditor actually do? They usually divide the financial statements into components or business transaction cycles, processes, or an account to go through an audit. And then we go through the process. So if you're looking for a here's how we do auditing answer, you're not going to get that. Okay, it's very different than what you learned in financial accounting or tax accounting. Here's the rule, follow it, you're done. In auditing, we have tools. And based on subjectivity, the expertise of the auditor, they will decide the tools to use on this company to conduct the audit. What we're doing is talking about those tools and looking at some examples. Now, as we said, when financial statements are handed to the auditor, there are assertions made by management. Current auditing standards state management's assertions fall into the following categories. They make assertions about the classes of transactions and events for the period under audit, assertions about the account balance at the period end, and assertions about presentation and disclosure of the financial statements themselves. So basically we're saying, and if you look in Practice Insight, and we saw this back in Chapter 1, our auditing standards allowed the auditor to use the category of assertions, okay, as shown here, or to express them differently. The PCAOB standards don't separate assertions into 3 categories. They have, I think, 5. But we're going to look at 3. Let's take a look. Here's our first one. The assertions management makes about transactions and events under audit. And these are explained in detail, so we want to take a good look at them. The first thing looked at in your book is I was distracted at my office. Occurrence. So back up, look at that sentence before there. Transaction-related assertions that management makes help the auditor think about, plan, and perform audit procedures. The first is occurrence. The occurrence assertion relates to whether all recorded transactions and events have occurred and pertain to the entity. So is everything recorded, and only those things pertaining to the entity recorded? The example given, management asserts that all revenue transactions during the period were valid transactions. That's what they are basically saying in the financial statements about the classes of transactions. Completeness. This relates to whether all transactions and events that occurred have been recorded. Okay. So if a company fails to record all their revenues, it will be understated. Authorization. Are only authorized transactions recorded? There might be a whole bunch of transactions there, but we don't know if they're authorized. Okay, there's an assertion there. Accuracy. The accuracy assertion addresses whether amounts and other data relating to recorded transactions have been recorded appropriately. So, did they record the cost of the machine appropriately? The purchase price plus all costs to get it ready for its first use. Cutoff. The cutoff assertion says that management properly cut off transactions. So all inventory that should be recorded is properly recorded in the proper year, is an example. Classification. Are transactions and events recorded in the proper accounts? Management asserts that maintenance costs to repair a machine that do not add to usefulness are charged to repairs and maintenance. So this first area deals with management's assertions by the transaction, occurrence, existence, completeness, authorization, accuracy and valuation, cutoff, classification, understandability. There's a great table on page 132 that summarizes that. The next level of assertion that management makes are about account balances at the end of the period. The assertion that about existence addresses whether ending balances of assets, liabilities, and equity actually exists. Rights and obligations. The company has a right to call that an asset. They own it. They can prove it. Completeness. All of the assets, liabilities, and equity have been included in the ending balances. And they're properly valued. They're at appropriate amounts, and any resulting valuation or allocation adjustments are recorded. That is what management is asserting. And I should have went to the next slide. There you go. So it exists, the balance, the items exist, it's complete, they have a right to it, they have obligations, and it's valued properly, and any allocation is done properly. That's what management is asserting to us as the auditors. The next level of assertion is the financial statement presentation and disclosure. What are they asserting there? Classification and understandability. Okay, that is saying that the classification of the financial information is appropriately presented and disclosures are clearly expressed. That's the assertion being made. Accuracy and valuation. That asserts whether the financials and other information is fair and in appropriate amounts. Completeness. Whether all disclosures are included that are required in the financial statements. That's what that addresses. And occurrence, rights and obligations. Disclosed events, transactions, and other matters have occurred and pertained to the entity. So this is at a financial statement level. So the first, those 5 or 6 assertions were at the transaction level. The next 4 assertions are at a account balance level. And then these 4 assertions are at a financial statement level. So here's an example of management's assertions, what we would perceive as a possible misstatement and an audit procedure. Management assertion for the accounts receivable component of the financial statements. So this is at the bottom of page 134, and there it is as well. Oh, I'm sorry, this is a different table, but I'm looking at the table on page 134. So management's assertions for the accounts receivable component of the financial statements. 1, it exists. The possible misstatement is there's fictitious customers in there. How could we determine if they exist? You confirm with the customers. We send out what's called confirmations, and those are audit evidence, and we'll talk more about those. They have a right and obligations. We check to see if any of the receivables have been sold, and we could inquire management about that. Determine completeness. Customer accounts are not recorded. That's the possible misstatement. What we do is agree subsidiary ledger totals to our general ledger accounts receivable totals. So the detail of the customers who owe us is added up and compared to the dollar amount in accounts receivable in the general ledger. Not us, but the company we are auditing. And then valuation or allocation. What's the possible misstatement there? There's delinquent receivables still in accounts receivable. So we want to see, is there enough allocated for our allowance for doubtful accounts? So you see, we need to have a good understanding of the accounting systems to begin with in order to perform the audit. That's why we're on a team. One person isn't going out and completing an audit based on what they learned in an auditing class. But you need to understand the tools of auditing. So as you go through the different phases of an audit and eventually take over the audit, it all comes together. So again, there's a table for assertions for transactions, account balances, presentation, and disclosures. And there's the rest of the table. So that's what we saw. I said it was a great table back on page 132. All right, so we know what the assertions are. So what kind of evidence do we have to collect about those assertions, basically, to come up with our audit report, our opinion? So audit evidence is all the information from whatever source used by the auditor in arriving at their conclusion on which the audit opinion is based. The concept of audit evidence is you need to look at the nature of the audit evidence, sufficiency and appropriateness of it, and the evaluation of it. So these are 3 very important concepts that you need to understand in order to plan and perform the audit. What type of audit evidence, how much, and how do we use it? So The nature. What kind? We have evidence from the accounting side, accounting records themselves, and then we have other information. Some examples of evidence used from the accounting side, the general and subsidiary ledgers, because this is where you're going to see the records of the initial entries and all the supporting records. Spreadsheets is another example supporting cost allocations, any special adjustments that were made to the financial statements, computations done, reconciliations like a bank reconciliation, and disclosures, invoices, contracts, worksheets, all the information used in the accounting system itself. That's one form or nature of audit evidence. The other is other, and that's in your book on page 135. Things such as minutes from meetings, maybe the board of directors or special meetings, confirmations from third parties. Basically, and we'll look at them in more detail, there's certain items on a financial statement that we could confirm to see if it's appropriately valued. Things like accounts receivable, accounts payable, inventory. Industry analyst reports, comparable data about competitors, control manuals. So where's the office manuals, right? Where's our procedure manuals? Look at that. Information obtained by the auditor from inquiry, observation, and inspection. Okay, so our point here is that it's everything. It's just not one little component we're looking at. Okay, now based on what we collect, we'll determine if it's reliable or not. And we're going to talk more about that in a second. The sufficiency of audit evidence is the measure of the quantity. So how much do we have to collect? The greater the risk of misstatement requires a higher quantity of evidence. Sure, because if you think that might be misstated, you want to look as much as possible to be sure it isn't. The other factor you look at, though, is if it's a highly quality audit evidence, like a confirmation. You don't have to look at as many of them. Lower quantity of audit evidence required. So these are the things you're going to look at to determine how much audit evidence do we need. What's the appropriateness? So this is a measure of the quality of the audit evidence. Is it relevant? Relevancy is the first. And this is described on page 136. And the example is a normal audit procedure for testing an assertion about whether all goods shipped to customers are recorded in a sales journal. So you want to determine, is everything that was shipped in the sales journal? Well, you'll want to go to the shipping documents, because that's where you document. The company normally documents everything that is shipped, and then go back to the sales journal to see that. If the auditor instead looks at sales invoices, well, that doesn't mean anything. That's what you billed. That's not what you shipped. And those are two different things. So you need to understand the difference between those two. And what is relevant? What are you trying to prove here? Make sure you're using relevant audit evidence. And then reliability. Can you rely on it? The more independent it is from the company, the more you can rely on it. So independent source outside the entity, like a bank statement, confirmation from a customer, or a confirmation from a supplier, is more reliable. The effectiveness of the internal control, the more effective an internal control, so the more that it's being followed and it's properly developed, you have less control risk. So those are more reliable. But if you look at an internal control and say there either isn't one or it's not that effective, you have a high risk of within that, a high control risk. So you're going to develop audit evidence, and the quantity will be based on that. What's more reliable here? Your direct personal knowledge. So if you have direct personal knowledge about something, that's more reliable. Okay, so you went and you examined the inventory. Well, that's reliable. The documentary evidence. If there's documentary evidence, it's written down, that's more reliable than not having any, right? Okay, something oral is not as reliable as something written, and original documents are more reliable than photocopies. Okay, so just to give you some feeling as to what we're talking about here. So when we are looking at audit evidence, we're going to look at how much, sufficiency, but also quality. What are we collecting, and isn't reliable and relevant? Once we collect that, then we evaluate it. Okay, and proper evaluation of evidence requires an understanding of what you collected, the types of evidence, and the relative reliability of available evidence. Okay, so they talk on page 137, and this is important. It's the first paragraph, last sentence. The auditor must be capable of assessing when a sufficient amount of appropriate evidence has been obtained in order to determine the fairness of management's assertions. That comes with experience. An auditor, though, must be thorough in searching for evidence and unbiased in its evaluation. So you can't let biases impact you. Okay, moving along. So now let's talk about audit procedures for obtaining evidence. What do we do to obtain it? Well, back in Chapter 3, we talked about 3 categories of audit procedures. Risk assessment procedures, which, if you remember, let's review it. It's used to obtain an understanding of the entity, its environment, the internal controls. We could assess the risk of material misstatement in the financial statements and relevant assertion levels. Remember, we did misstatement, material misstatement, tolerable misstatement. Test of controls we use to test the operating effectiveness of the controls in preventing, detecting, and correcting material misstatements at the relevant assertion levels. And in the next chapter, we're going to talk in detail more about how do you test controls. The last audit procedure is substantive test. And we're using these to detect material misstatements at the relevant assertion level. Substantive procedures include test of details and analytical procedures. So, what kind of evidence then are we collecting during these audit procedures? Before we do that, though, let's mention this. A set of audit procedures. So the things that tell you what you're going to do to test assertions for a component of the financial statements is referred to as an audit program. So you may have together, you may have an audit program for a business cycle, an account, but it's the steps you're going to take to collect the evidence. So for instance, an audit program for accounts receivable, we looked at this a few minutes ago, but what would it do? Well, management assertions about accounts receivable is that it exists. So we'll want to confirm that it does. It has the right and obligation. We want to check to see, have they sold anything? It's complete. So we agreed the subsidiary ledger to the accounts receivable control account, and it's valued or allocated correctly. So maybe we test the adequacy of the allowance for doubtful accounts. These kind of audit procedures will provide us the audit evidence we need about accounts receivable. Before we go to the specific evidence itself, take a look on page 138. It says, around halfway down the page, the following types of evidence may be gathered during any of the phases of the audit procedures. So this could be happening during risk assessment, these types of evidence, test of controls, or substantive procedures. The common things, we're going to go through each one of them. Inspection of records, inspection of tangible assets, observations, inquiry, confirmation, recalculation, reperformance, analytical procedures, and scanning. And we're going to spend some time on analytical procedures at the end of the presentation. So the first way audit procedure for obtaining audit evidence is inspection of the records and documents. So we're looking at evidence from external documents is more reliable than evidence obtained from internal documents. Now, if we're trying to determine that all the items in the journal actually occurred, we may want to vouch them. How do we do that? And this is testing for occurrence. We go from the journal back to the source document, the sales invoice, the check, whatever it may be. That proves it occurred. So occurrence is tested by vouching from the ledger to the source document. The other kind of procedure is tracing, and that tests for completeness. Is everything in the source document file in the journal? So are all the checks recorded? Are all the sales invoices recorded? Are all the whatever's invoices recorded? You're looking at many different kind of things. So there's two different things we do. One for occurrence to determine if that assertion is met, and completeness to determine if that assertion is met. Another, inspection of tangible assets. So you're going and looking at them. You do a physical examination of them. For instance, I used to do that. I audited a few different companies locally. One was a building company. The whole accounting firm, because there was only 10 of us or 11 of us, went and counted the inventory. We examined it. I have examined plant assets, property, plants, and equipment to make sure it exists. Okay, so it's just a physical looking at it, maybe going from a list of items to the item itself, and it's properly tagged so that you could do that. Observation. You watch a process or procedure being performed by others. Now, this is more for information purposes more than evidence. It's good for you understanding the company. And going back to physical examination, and they mentioned this, and actually I used to audit a bank, and their year end was December 31st. And we would walk in right before Christmas. It was usually 2 or 3 days before Christmas, right before the bank closed, and did a surprise audit of their cash. And it's mostly women tellers, and they'd be so mad because they wanted to go Christmas shopping, but they knew we would be coming, and that was part of our audit process. We would go in, we would count all the cash in their drawers, everything in the bank. We would do a check on their certificates of deposits. We would add those all up and examine them to prove that their cash balance was correct, because it was material amount and it was a surprise. So it was a good piece of audit evidence. Inquiry. So we would ask, and we need to make sure we're inquiring of the appropriate person. So we have to make sure we understand their knowledge, objectivity, experience, responsibility, and qualifications. I mean, we're not going to ask somebody who doesn't know anything about cash. We have to make sure our questions are clear, concise, and relevant. Everybody in the company cringes when the auditor walks in. And you could be the nicest person in the world, but all they're thinking is they're trying to find something. And that's usually the mentality of people. So you want to make sure they're comfortable answering your questions and that you ask appropriate questions. You could ask yes or no questions or open questions so that they have to elaborate more. And you must listen actively and effectively. You can't just be looking at your phone while they're answering you. You have to be involved in that conversation and document. You need to consider the reactions and responses and ask follow-up questions, especially if it's getting into more, areas that you're really questioning, ooh, what's going on here, because you're not feeling comfortable with it. You want to make sure you're doing that appropriately. And finally, you want to evaluate the response. Did it answer my question? And do I need to find out more? Inquiry is a great procedure to do to collect audit evidence. It may lead you to have to do other audit procedures to follow up and get more evidence. Confirmation process, which is probably one of the most reliable. It's a process of obtaining a representation of information or of an existing condition from a third party. So we can confirm, and these are great. At the bottom of page 141 are some common confirmations sent out. We can confirm with the bank the cash balance. We can confirm with customers their accounts receivable balance. If there's any consigned inventory, we could contact the consignee. Accounts payable, we could confirm with the individual vendors. Same with bonds and common stockholders, insurance companies, and creditors for collateral. So there's lots of things that we can confirm directly with the people involved in it, and they're independent of the company. Now, the reliability of evidence obtained through external confirmation may be affected by the form of the confirmation, prior experience with the entity. Sometimes these people won't even send anything back. What are we confirming? And the intended respondent. So these affect the confirmation evidence. And there's our list again. Those are great people to confirm information with. Another audit procedure is recalculation. Just check the mathematical accuracy of documents or records. Okay, and they talk about specific examples, include recalculation of depreciation expense on plant assets or on accrued interest. So that's something that could be very easily done. Or do the reperformance as another procedure. The auditor's independent execution of the procedure or controls that were originally performed by company personnel. So the auditor goes through and does exactly what the company said it did, and it should end up with the same result in their evidence. And finally, analytical procedures, which we're going to talk about in more detail in a few. Evaluations of financial information made by a study of plausible relationships among both financial and non-financial data. And we said before, audit analytical procedures can be used in the risk assessment procedure during our preliminary planning, preliminary analytical procedures, our substantive analytical procedures. This will give us evidential matter about assertions related to account balances or classes of transactions. And then our final analytical procedures to look at an overview of the financial information in that final review stage of the audit. So as I said, in a couple minutes here, we're going to look at specific analytical procedures used. You've seen a few already to collect that evidence. And then scanning is probably our last one. This is judgmentally review accounting data to identify significant or unusual items to test. So you just take a scan and you're like, whoa, that number's too big, or wow, that's really low. Okay, than what you're used to seeing. And that's based on experience and professional judgment as well. So we just want to introduce you to the different types of procedures that are used to obtain evidence. Now, some evidence that is considered highly reliable: the inspection of tangible assets, reperformance, and recalculation. The lowest is observation and inquiry. And in the middle are inspection of records and documents, confirmation, analytical procedures, and scanning. Okay, so it's just trying to give you a feel for what do we feel is really reliable and what isn't as reliable. So if you have a choice between different procedures, you may want to pick one over the other. So this is our audit testing hierarchy and an evidence decision process for testing classes of transactions or significant balances. And this is also on page 144 of your book. So it's just an example. After assessing the potential effectiveness of internal controls, this is what auditors do, will tests of controls be conducted? So you look to see, how does the company handle paying cash? And you look at their internal controls and you say, do we need to test them? Yes. Then we're going to perform tests of controls and make an assessment based on that. That's what's in Chapter 6. If you say no, and by the way, the answer is always yes for public companies. If the answer is no, then you go down. Or after you test internal controls, can effective and efficient substantive analytical tests be performed? If the answer is yes, perform them. If the answer is no, you go directly to perform substantive tests of details on transactions or balances. So now you're collecting audit evidence, tracing, vouching, doing things like that. Confirmations, inquiries, whatever you decide needs to be done and has the strongest evidence about that account, because I think this was for testing, classes or transactions. So that's more of the vouching and tracing. Now, if you perform substantive analytical tests, you ask yourself, is additional substantive evidence needed? If the answer is yes, then you go and do your substantive tests on the details of the transaction and or balances. Okay, so that's the normal type of hierarchy we go through when we are looking at accounts or business cycles, processes like the cash process, cash payment process, cash receipt process, purchasing process. Okay, now filling the assurance bucket. An auditor will require a certain level of assurance. I just want to catch up with some of my notes here, just so I don't miss anything. Okay. Yep. Okay, we're good there. Sorry, just give me a second here. All right. They're going to fill up their assurance buckets. First, they do their risk assessment procedure. That's in the very beginning of the audit. And based on that, they will determine tests of controls. And they're going to weight each of these based on their subjective evaluation and professional judgment. So there's no magical number here. Well, if your risk assessment procedure turns out to be 20%, no, you determine how much weight do I want to put to the risk assessment procedure. Okay, so then based on that, how much weight will I put on test of controls to feel assurance that the account is good, it's correct, or the business cycle is. Then I'm going to do substantive analytical procedures, ratio analysis, compare balances, things like that. Based on those three things, now I'll determine any other evidence I need. What kind of procedures do I need to do to test the details? Do I need to trace? Do I need to vouch? Do I need to confirm? Do I need to inquire, etc.? And all of that through those 4 levels that's where you're collecting all your information and evidence and documenting it to get the required assurance you want about a particular item. Now, here's some more examples of filling the assurance bucket, okay? And we're going to talk more about these in detail. Okay, so this is for accounts receivable, and this is on page 146. So an accounts payable example of filling the assurance buckets for each assertion. First, control risk and risk assessment procedures. So during this process, you may determine valuation, existence or occurrence. You're using cutoff, accuracy, completeness. That's how you're filling your bucket. Test of details. You'll fill certain buckets with that information, and then your substantive analytical procedures. So that when your buckets are full there for those various assertions, you feel comfortable about your overall assurance level. The auditor's record of the audit procedures performed, evidence obtained, and conclusions reached must be documented. It's your evidence. It provides support for the audit report. It aids in the planning, performance, and supervision of the audit. And it provides a focal point for reviewing the work of the subordinates for quality reviews. So you have a good review of the information. Audit documentation must be organized so audit team members and others can find evidence. All audit documentation is the property of the auditor, including documents prepared by the entity at the auditor's request. That's very important. Sarbanes-Oxley requires audit documentation to be retained for a number of years from the completion date of the audit. So we want to keep those things in mind. They should demonstrate how the audit complied with auditing and professional practice standards. So you have to have that in your audit documentation. Support the basis for the auditor's conclusion concerning each material financial statement assertion, and demonstrate that the underlying accounting records agreed or reconciled with the financial statements. So you're documenting a couple different things there. It should include a written audit program detailing the audit procedures used to accomplish your audit objectives. Enable a knowledgeable and experienced reviewer to understand the nature, timing, extent, and results of the audit procedures you used, the evidence you obtained, and the conclusions reached on that evidence. So this is all detailed out. That's why on that last earthware, you need to explain everything as in much detail as possible. And some of you caught on to that. Some of you would just put in an answer box, an explanation box, no. But you need to say why you came up with the answer no. And that's why I attached the answer key there. Just get into the habit of doing that. I wasn't penalizing you on a lot of points because you are new to this. But I need you to understand that is very, very important. You also need to determine who performed and reviewed the work, as well as the dates of the work and reviews. That's very, very important. Before we get to this, so you know, years ago when I was first in auditing, I haven't audited in a very long time, but in the beginning of my career, I did for about 6 years. And I wasn't exclusively an auditor. I was more of a tax person, but I have experience with audit. I don't have experience with SOX on an audit, and I never would because I would never be involved with a public company audit just from where I worked. But one very important thing that happens to auditors now is that they have firm reviews, meaning other CPA firms come in and audit them. It's a review. I forget what they call it officially, but there is a name for it. And they look at your audit work papers, your audit documentation, we call them work papers, to see, are you doing all these things? Because if you're not following the rules. And there's a question of your ability as an auditor. So it's very, very important. Most public accounting firms maintain 2 types of audit files on their clients. Permanent files, they'll have information in there that doesn't change from year to year. Corporate charter, contracts, chart of accounts, internal control documentation, organization chart, many other things, but more of a permanent type of nature. And then there's the current files, the evidence files used for this year to collect and the audit procedures and plan and all of that used for this year's audit to come up with our opinion. Most public accounting firms maintain 2 types, and there's the current file audit report, adjusting journal entries, audit plan and programs, journal entries that we needed to have the company do to reclassify information, a trial balance, financial statements, maybe some minutes of current year meetings, and then those working papers supporting our evidence for account balances and processes. The format of your audit documentation. This is important. You have to make sure you have on every page entity name that you're auditing, the title of the working paper, and the entity's year-end date. You have to index and cross-reference. Notations that provide a trail from the financial statements to the audit documents. One typical is called a tick mark. These are notations made next to work paper items indicating that about the auditor or reviewer actions. So you'll see a lot of these in the coming chapters when we start looking at specific audit procedures for business cycles. Here we're just giving you a general overview. Okay, so that takes us through the end of the chapter, but into our first advanced module 1, Analytical Procedures. Remember, we were saying these things are pretty important. They help us to assess risk. And this is used to assist the auditor to better understand the business and plan the nature, timing, and extent of the audit procedures to collect the evidence. There's substantive analytical procedures. They're used to obtain evidential matter about a particular assertion related to an account balance or class of transaction. And then a final analytical procedure that's used as an overall review of the financial information in the final review stage of the audit. So these analytical procedures are done at different points during the audit. The typical ones that are done: trend analysis, ratio analysis, and reasonableness analysis. Okay, I'm going to probably have you go to a page 155 of your book. Now, in a substantive analytical procedure, this is on page 154, the first step you must do is develop an expectation for the amount or account balance. And he goes on to say, this is the most important step in performing analytical procedures. Auditing standards require the auditor to have an expectation whenever analytical procedures are used. How do you do that? Base it on financial and operating data, budgets and forecasts, what others in the industry are doing, your competitors, the company's competitors, what management thinks should be happening, analyst reports. So there's information out there for you to develop this expectation, and that's what you do. Define a tolerable difference, and you're going to be doing that in your earthware. Okay, and actually, based on a tolerable difference, you're going to be taking it to the next step. Compare the expectation to the recorded amount. Okay, so what do we expect and where's it at? Is the difference greater than the tolerable difference? So that's what you're going to say. Items where this comparison, the difference was greater than the tolerable difference. If the answer is yes, now here's what you're going to be focusing on. Investigate the difference. Are there patterns, trends, relationships, and possible causes? Ask management. Obtain evidence. Okay, so did you collect enough evidence to understand what the difference is? Yes. Then you accept the amount. If the answer is no, now we're doing other audit procedures to determine what is the correct balance. Okay, so this is all done really in the planning. Great reading on page 156 and 157. And on page 157 is an example of a common size income statement. And I'm pretty sure you see this one in your earthware, clothier. They have their 2015, 14, and 13. And in your Connect assignment for earthware, you're going to see 2016. And it has their income statement for each year. And it shows their vertical analysis. Remember, vertical analysis is where we compare each item on our income statement to net sales. So what percentage is each one of net sales? So you would take, for example, in 2015, cost of goods, cost of sales, 546,393 divided by 950,484 gives us 57.49. Then do the same with gross profit. So the denominator will always be net sales. Your numerator will be each item on here. So take a run through that. Make sure you understand that process. You learned it back in Intermediate 2, or you should have, and your Accounting 101. That's why those items were so important, not only to an accountant, but they also are to an auditor. So once you do those, you can now compare yourself, compare internally. What did we do last year in those categories, percentage-wise? You can compare it to budgets. You can compare to your industry data, industry averages. Okay, so we develop an expectation based on that information and then compare. Now, the size of the tolerable difference, and this is a judgment call again, is based on the significance of the account, the desired degree of reliance that you want to place on these analytical procedures, the level of disaggregation in the amount being tested, and the precision of the expectation. Remember, the amount is always less than overall materiality. So this is helping us formulate our procedures and develop our plan for our audit. This is happening during those planning stages. You want to compare the expectation to the recorded amount, as we did in that flow chart, and investigate any differences greater than that tolerable difference. Okay. And then based on that information, you will create your audit strategy. Risk assessment procedures, differences. And I want to take you to that page. Sorry, just give me a second. I'm lost my spot here. If you take a look on page 158, there's some great trend analysis that shows you how an item changes over time. And if you graph it, oh, it's such a nice picture there. Okay. I'm sorry, I wanted to go to final analytical procedure difference. Cooperating evidence is required. Risk assessment procedure differences, you don't need cooperating evidence. That's all that's stating there. On page 162, those final analytical procedures are addressed. So the objective of analytical procedures at the overall review stage of an audit is to assist the auditor in assessing conclusions reached and evaluating the overall financial statement presentation. It requires the trial balance, financial statements, and footnotes in order to judge the adequacy of the evidence gathered and determine if any unusual balances or relationships have been investigated. So that's what you're testing for during that analytical procedure, using these tools. A very common tool used is ratio analysis, and you need to be familiar with these at this point in your education. If you aren't, take a look at them. I'm going to explain them a little bit, and hopefully if you've or like, I heard of that, I'm not sure what it is. Here it goes again. The current ratio is demonstrated on page 163. It's basically current assets divided by current liabilities. And it just gives the ability of the company to pay their current liabilities with their current assets. Companies usually like to see somewhere around 1. So for every dollar in current liabilities, if your answer current ratio is 1, you have $1 in current assets. But it is based on the industry and the company. The quick ratio takes liquid assets, cash, accounts receivable, short-term investments, those that can be converted to cash very, very quickly, and divides that by current liabilities. So it's almost saying if all your current liabilities became due, would you have cash assets to pay them? If your answer is 1, the answer is yes. But like in our computation here, it's 53, meaning they would have 53 cents in liquid assets to pay $1 of current liabilities. I'm not judging them. I'm just telling you what they mean. And then operating cash flows. You take the cash flow from operations right off your cash flow statement and divide that by current liabilities. So that's telling you your cash flow from your operating activities, how much of that you produce to pay your current liabilities. Okay, so it's measuring how well a company could pay their current liabilities with their current assets or liquid assets. Activity ratios, receivable turnover and inventory turnover. Great ratios, used a lot in business by managers. The first one you find by taking your credit sales only and dividing it by usually average receivables or just receivables. And that tells you how many times a year you collect on your receivables. If you take that answer and divide it into 365 days, it'll tell you how many days it takes you to collect an accounts receivable from the point of sale to the day of cash collection. Inventory turnover is calculated the same way. You take cost of goods sold divided by inventory. That tells you how many times a year you sell out your inventory or have to replace your inventory. If you take, that should be days outstanding in inventory, or days, that second little line there, under inventory turnover, days of inventory on hand. So if you take 365 days divided by inventory turnover, it tells you how many days it takes you to sell your inventory on average. Okay, so these are analytical procedures, activity ratios to help us find some weird stuff or unusual items. Profitability ratios. So of course they're measuring profitability. The first is the gross profit percentage, gross profit divided by net sales. So that's the percentage of profit you have after paying for inventory. Profit margin is net income divided by net sales. That's how much you have percentage-wise of your net sales after everything's paid for. That's what's left over for the owners. Return on assets. And, that's net income divided by total assets. And that's basically saying how well we use our assets to generate a profit. Okay, so if you want to look at this from a savings account perspective, savings account is an investment. It's like your total assets. Interest is like net income. It's the return on those assets. When we put money in a savings account, they tell us our interest rate. But when we put money into a company, we don't. So if we take the net income that's generated from the assets that the company has from the owners and creditors, because that's where they get the money for those assets, the company produces a 6.8% return on page 165. Okay, so we want to watch that percentage within the industry or across years. Is there any anomaly there? Is there something weird happening with that? Should basically stay pretty consistent unless there's an explanation for it. Not. Return on equity is just measuring the return to the shareholders. So we take net income divided by stockholders' equity. Stockholders' equity is basically the amounts of money that the stockholders have invested in the company. So the company takes their money, creates a net income, a return to them, and it comes out to be 11%. So it's profitability ratios. Debt to equity. Debt to equity is where we take our short-term and long-term debt divided by stockholders' equity. It just indicates the portion of the capital, entity's capital, comes from debt. Okay, the lower the ratio, the less debt pressure. And times interest earned. That measures how many times a company could pay its interest with its earnings. If you notice, it says net income plus interest expense. That's where the company has to get its money to pay its interest expense. So they say, well, how much income do we have to pay our interest expense? Now divide it by interest expense. So the more times a company could pay with their earnings, the better off they are, right? The better the ability of the entity to pay their interest. So it's measuring how well a company could pay their long-term debt, either debt to equity, the principal portion, or the interest portion. So all of these ratios, along with that vertical analysis we saw in the beginning, are analytical procedures used in the preliminary stage, during, and after to determine things that need to be looked at in more detail. So you want to be familiar with those and what they mean. Okay, so that's the end of our discussion on Chapter 5. I encourage you to post any questions you may have, email me, and attend the office hour on Sunday night. Thanks.